Welcome to our weekly market review. It's brought to you by Treasury One and ETM Analytics. I'm Ilse Marie Leroux. I'm joined by Andre Celia again this week. Welcome back, Andre. He's the currency strategist at Treasury One. And a big interesting day in Japan. Actually, Japan has been having an interesting year because they obviously decided to abandon their negative interest rate. I almost wanted to call it a fiasco, and they barely jumped over the line into positive territory. I think it's between 0 and 0.1%, the interest rate at the moment. But the yen moved to 160 against the US dollar for the first time, I think, in more than 30 years. Now, there's been some intraday changes that's happened. It's since reversed throughout Monday, which is a bit suspicious. Some red flags that there's been market intervention, but of course, we know that's nothing new in the Japanese market.
Yes, good morning to everybody. If we look at the yen, as you mentioned, an horrendous couple of months that's behind it. The market is a bit disappointed. The inflation is well above what the interest rates are, and everybody expected them to abandon their negative interest rate policy, which they've done, but markets expected them to be a little bit more aggressive. Instead of a 0.1% move at a time, they expected, I think, more closer to a 0.25% move. 0.25% move, you know what is sort of the norm now in Europe and America. And I think that was expected that the Japanese, with where inflation is, would also move at least with a 0.25 of a percentage point, and they didn't. It was expected that last week during the monetary policy meeting that they should really do something again and increase interest rates, which they didn't do. And I think the market was very disappointed with that. Now, for the last 2-3 weeks, we've been speaking about possible intervention, and we've not seen any intervention by a central bank, by the Japanese central bank as yet. And I think the market is kind of sort of pushing the limits here in speculation, in waiting for a central bank move or an announcement or something to happen from that monetary policy side, or strengthening their currency, which is not happening. So there's now speculation that this morning, when it reached the 160 level, that there could have been some intervention because we're down to the 155, almost 156 area again. But the Japanese markets are closed today, but you don't necessarily need to do your intervention yourself. You could get a couple of other banks to assist. But I doubt whether there was intervention. I think at this point in time, it's a little bit of profit taking with the way the yen has moved. So I think that possibility of intervention is still there. But the history has told us that intervention is a very short-term move and not a long-term move. So I think the yen is still in for further weakening, further bouts of weakening. We need a change in monetary policy. We need a change in the interest rates a little bit more aggressively to distract any further weakness from the yen and move it into positive territory.
Yes, and of course, what could make matters worse is the FOMC, the decision out of the US coming out later this week, because, the weaker than expected GDP figures from last week aside, we know that inflation is still above target. Jerome Powell, the Fed chair, has been very clear that, with the narrative of it's going to be higher rates for longer. And now it might be even much, much, much longer. That's kind of the message that we're expecting to come out later this week from the FOMC. And this is obviously bad news for the yen as well. So it's going to be a tough market that. Your thoughts on this week's decision? You agree?
Well, if we look, GDP figures came in a lot lower than that was expected. Came in at 1.6 versus 2.8 or 2.7, what they expected. So that came in a lot more negative. We had seen last week also that the manufacturing index was lower. We had also seen that the PCE price deflator came in 0.1% above what was expected. So no, I'm not so quite convinced that the rhetoric changes. I think Mr. Powell hits the same little bandwagon, the same little note. Interest rates will remain higher for longer. Inflation is still not contained, blah, blah, blah. So I think very little. I don't think he becomes anything more aggressive or anything. I think the same sort of speech is with us, and I'm still on comes closer to the end of this 2024 year that we might still see interest rates coming lower. Economies are an interesting one. You know, it could change very, very quickly. I think the one thing that the Americans definitely don't want is they don't want to use the word recession. So if we now the first quarter where it's now declined, no, they want second quarters and third quarters where the growth comes lower, because then that official technical recession talks are there, and I think they want to avoid that. Equity markets and everything would react quite sharply to that. So I think they would want to avoid that. So now comes end of the third quarter, beginning of the fourth quarter, I still think that we're in for an interest rate change. And I don't think that the Fed is going to be a lot more aggressive in their rhetoric speech after the meeting this week at all.
Obviously, one of the things that's keeping the Fed or giving the Fed room to stay with interest rates where it's at is the jobs market that just, I almost want to say it keeps on holding up amid the monetary pressure, with the US non-farm payrolls out on Friday later this week. And again, we're expecting more jobs to be added this time around as well. No change there. If we can just get that slide as well. On the market expectations around the US non-farm payrolls. I'm pretty sure we put it in. Not yet.
Well, even if it's not
there
in there,
go.
there it is. There it is. But I mean, when we speak about jobs in America, then we just go back to last week and Mr. Biden signs a couple of bills and makes an announcement and says, we are aiding the Ukraine, we are aiding Russia, not Russia, we're aiding Israel, and we're throwing some money towards Taiwan. And you add up those figures and you come to $95 billion. And I've said this before and I'll say it again. It's not an EFT to the Ukraine. It's not an EFT to Israel. It's an EFT to weapon and armory manufacturers within America. Somebody needs to build it. Somebody needs to push out those missiles and tanks and whatever and then put it onto a ship. And that's people. They got to build it. There's your jobs. It's not going to change. As long as you throw money into these wars and it's being spent in your own country, you are going to create jobs. And that helps Mr. Powell. But I don't think it helps him to that end that the economy grows that much, because I think there's quite a few other sectors in the economy that's not doing well. And I think it was mentioned before, and it's been said before, that if you look at the money that was printed during the COVID period, aggressive money, checks being sent to people, but a lot of that money has found its way already into markets, and the savings is not that high anymore. So, there's changes in the American economy that could sort of push Mr. Powell into the area of avoid the recessions, avoid the other sectors seeing its backsides, and lower your interest rates. But non-farm payrolls will continue growing simply because we're pushing in a lot of money into the military.
Yeah, you get this idea that, the strength that we are seeing is kind of propped up by the COVID stimulus. We know that is busy unwinding the military expenditure from the US. But the problem that I think that they're going to face, and when it starts to unwind, it's going to unwind possibly very quickly, and that rate is going to be very quickly. And that, I think, is something that Powell will have to keep in mind to try almost and get ahead of that curve, to make sure, like you said, that they avoid the big R word, the recession that no one wants to talk about.
No, nobody wants to hear that.
But the FOMC and the US non-farm payrolls out this week likely to give more direction to the rand. We know that the rand strengthened somewhat last week. Not a lot of underlying factors that will support that momentum really going forward.
No, there's not a lot of underlying factors, and we must keep in mind that we're moving closer and closer to the elections, and it's becoming more and more interesting as to what happens there. But everything that we've spoken about really keeps the euro and the pound in narrow trading ranges against the dollar. And as long as those trading ranges against the dollar remains fairly close and tight, the rand remains very happy in this broader 1820, 1920 ranges. And I think it's going to remain there, So non-farm payrolls figure this week, positive or negative, is not going to make us break out of these ranges. At this point in time, we need something really, really drastic that's going to break this. But for the moment, I think very happy. And importers, when we get to the lower levels, look at doing something and cover yourself. And the exporters, I think the last 3 months has given us this information very, very clear. When you see the 1920 and a little bit above, take some cover and protect yourself and lock in some of your profits.
Speaking of the elections, for anyone that is interested, ETM Analytics and Econometrics, our other sister company, with George Glenos, myself, Azar Jameen, and Jeff Denham, we did a full discussion on possible post-election economic landscape for South Africa. We had a good discussion on that. It's available on our YouTube channel. It's called Markets Magnified, or ETM's Markets Magnified, because obviously that is the one thing that's at the front of every South African, whether you're a trader or investor or exporter, everyone is kind of on tenterhooks on what we can expect post 29 May. Andre, you are obviously out and about still, so please just travel safely, and we will catch up with you again next week.
Thank you very much.